The selling of Chinese equities has become indiscriminate. In the media, the bad news has of course been centered around the main indices, particularly the Hang Seng Index. But the real drivers of the fear out there have been amongst the consumer-facing online platform companies. They're the ones in the regulatory spotlight for scrutiny on matters that are quite mainstream policy concerns in the developed markets. These include, amongst other things, antitrust, consumer protection, and data privacy issues. Note that tech companies with harder, core, cutting-edge technology, such as those on the Star 50 index, have been quite resilient amidst the ongoing storm. Over the past month, the Hang Seng Index fell 9.7% and the HSCEI fell 12.9%. The CSI 300 was down by a smaller 6.5%, and the Star 50 was actually slightly higher by 1.6%. So the first takeaway is that for opportunities, look to A shares, which have been and are likely to continue to be more resilient than H shares. Within H shares, the real damage has been in Hang Seng Tech, which is down some 16.9%, and the CSI Overseas China Internet Index, which is down 25.7%. Now, this is the real focus of the Chinese regulatory blitz. Its constituent stocks include Alibaba, Meituan, Tencent, Tencent Music, and TAL Education. So the second takeaway is favor tech companies that are likely to drive China's economic growth rather than online platform and app companies that derive their success from China's economic growth. Look at the sudden, violent divergence between SMIC and Tencent over the past week and a half. The two stocks had been tracking each other quite closely until recently, so one stock's losses appear to have been the other's gains. Next, look also at the big CSI 300 index stocks, companies that are part of the foundations of the Chinese economy. These companies have been beaten down as well as fear spread beyond reason. The Chinese government isn't trying to destroy the stock market. It is trying to regulate companies that had been operating in a gray area of governance. For example, it has been trying to level the playing field between fintechs and banks. Now, why should fintechs be allowed to take deposits and lend money without the same capital adequacy and leverage controls as banks? It has been cracking down as well on anti-competitive practices within China's big tech. It has also been regulating for better consumer data privacy. Now, none of this is unique to China. Indeed, a recent Washington Post headline read, "China is doing what the US can't seem to, regulate its tech giants." So as fear spreads, we would be shopping around for value opportunities among key index stocks and amongst companies that can drive China's productivity growth and drive China's technological independence.